All right, let's dive into the latest earnings call from Mahanagar Gas, or MGL. You know, for any long-term investor, these calls are absolute gold. They're way more than just numbers. They're a peek behind the curtain at a company's real strategy. And trust me, MGL's recent call served up a fascinating puzzle that we are going to solve together.
So right out of the gate, MGL hits us with a pretty impressive number. For the first half of the year, their total gas sales volume shot up by almost 10% compared to last year. I mean, that looks great, right? It's a solid sign that the business is growing. But that big, flashy number is actually hiding a much more complicated story about their bottom line.
And that's the big mystery here, isn't it? Because even though they were selling a lot more gas, their actual profits took a serious hit. So how on earth does that happen? How can you grow your sales like that, but see your profitability go down? That is the core question we are going to unpack today.
To get to the bottom of this, we really have to zoom in on the numbers from the second quarter. And what you'll see is that there are kind of two different stories playing out at the exact same time. One of really impressive sales growth, and another of a pretty significant drop in how much money they're making from all that gas.
Okay, so this chart basically lays the problem bare. MGL's profit margin, the money they make on each unit of gas, it just dropped a lot. They went from making around 10 rupees per unit in the first half of the year to just 8 rupees in this last quarter. So yeah, they sold more gas, but every single one of those sales was just less profitable.
Right, so this is what everyone on the call wanted to know. What's causing this margin squeeze? What's really behind this drop in profitability? You can bet the analysts were pressing for answers, and to their credit, management was actually pretty upfront about the reasons.
But before we get into the weeds, let's just quickly nail down this one key term, margin per SCM. All this really means is the core profit MGL makes on each standard cubic meter of gas it sells. Think of it as the purest measure of how profitable their main product is. For a business like this, it's an absolutely critical number to watch.
So management basically pointed to a perfect storm of 4 different things hitting them all at once. First, they got less of that cheap, government-regulated gas, which forced them to buy more expensive stuff on the open market. Second, the price of that imported gas was already high. Third, a stronger US dollar made those imports even pricier. And finally, to hang on to their big industrial clients, they had to cut them a better deal on prices. It was just a classic squeeze from all sides.
Now, after hearing all that, you'd think management would be, a little worried. But their response points to a very deliberate, very clear long-term strategy. It seems they're not just reacting to this pressure on their margins, they're actively choosing a path that puts something else first.
And this right here, this quote from the call is everything. It pretty much sums up their entire playbook. An analyst was asking about their main focus, and management was crystal clear. Growing the sheer volume of gas they sell is way more important to them right now than protecting their profit margins in the short term. This is the absolute key to understanding everything they're doing.
So how are they actually putting this philosophy into action? Well, it's a pretty clear 3-step game plan. Step 1, focus on volume over those short-term margins. We get that. Step 2, go on an absolute building spree, aggressively expanding their infrastructure. Get this, they're targeting 80 new CNG stations just this year. And step 3, zero in on capturing that super valuable commercial vehicle market with new loyalty programs. It's all about building a bigger, more dominant network for the future.
Of course, a plan this aggressive, it's definitely not without its risks. And you can bet the analysts on the call were all over this, pressing management on the potential challenges up ahead. So let's take a look at what's really on the horizon.
2 major risks really stole the show in the conversation. In the short term, it's all about the crazy ups and downs of gas costs, the stuff we just talked about. But looking further down the road, the huge question mark hanging over everything, the one on every investor's mind, is the long-term threat from electric vehicles.
When it came to the whole EV question, management seemed pretty unfazed. They argued that in their main market of Mumbai, EVs face some massive hurdles, like a serious lack of charging stations. They also pointed out that the high price you pay upfront for an EV and its low resale value are still big turnoffs for a lot of people. And maybe most importantly, they kept hammering home that their real focus is on heavy commercial vehicles, a market where EV adoption is still incredibly low. And you know what really stood out during the entire call was the tone of the management team. They weren't cautious, they weren't evasive. They came across as incredibly confident and just laser-focused on their plan. They didn't try to downplay the margin squeeze. They explained exactly why it was happening and kept tying every decision back to their core strategy of long-term volume growth.
Okay, so let's boil all this down. If you're looking at MGL as a long-term investment, what's the real story here? It all comes down to understanding the fundamental trade-off that MGL is making right now.
And here it is, plain and simple. The bet they're making is that by focusing on aggressive volume growth and building out their infrastructure now, they'll secure total market dominance for years to come. And the trade-off? They have to be willing to accept lower and probably more volatile profits in the short term to make that happen.
And that really leaves us with the million-dollar question for anyone looking at MGL today, right? Are they making a smart, strategic sacrifice of today's profits to build a fortress for tomorrow? Or is this short-term pressure on their profits a risk that's just too big to ignore? Based on this call, management has clearly placed its bet. Now it's up to investors to decide if they want to bet alongside them.